Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back for another weekly review, this time for the week ending March 31st, 2023. Let's start with a look at this week's markets at the close on Thursday. Negative for bonds, positive for stocks. It seems that the calm is back in the market, so interest rates are rising again. The stock market is having some short-term momentum. The Canadian dollar was very strong versus the US dollar. In fact, it's the US dollar that's giving back some of the recent gains that were safe haven flows in the period of turbulence with the situation with the banks. So now Canadian dollar higher, euro higher, which means that when you bring everything into Canadian dollars, well, TSX had a good week. Elsewhere around the world, this negates some of the returns. Negative for bonds quite a bit. I mean, 1.18% negative for the Universe Index on the week. Price of oil higher, 7.4%. That's a strong week. Still negative year to date, but the price of gold still accumulating some gains now, close to 10% year to date. So we still have to talk about inflation, and it's important here to look to have a good view of the backdrop, given the fact that the markets are pricing in rate cuts for the second half of this year, which we think is not consistent with what we're seeing in the data. Let's start with the monthly inflation. So it's important to look at inflation monthly rather than year over year right now because of the base effects. But we're looking here at PCE inflation, which is just a different measure of inflation. We tend to look at CPI in Canada. In the US, they have CPI and PCE, but the Fed focuses on PCE and more specifically core PCE. So in January, we had inflation of 0.6% month over month on core PCE. February, we just got the data, it's 0.3%, so it's a bit slower, but still the pace, the impulse in the short term is still too hot for comfort. If you annualize 0.3%, you get somewhere around 4% inflation. Last month, 0.6%. If you annualize that, you get something between 7 and 8%. So if you take the two together, because the 0.3 is on top of the 0.6, that gives you still a pretty strong impulse, and it's too hot for comfort. So it's hard to see the Fed thinking about cutting rates in H2, given how strong inflation remains after all of this tightening, because it takes 18 to 24 months to see the full impacts of rate cuts, of rate hikes and cuts also. But here we're talking about rate hikes. So expecting rate cuts in H2, it's not consistent with the data. And here, this is a chart from BlackRock that you see on the left. It's not ours, but it's the expectations that the Fed publishes every other meeting. They publish the survey of economic projections and look at what they're expecting for inflation in late 2023, the yellow line, and for GDP growth at the end of 2023. So every time that they update their forecast, they tend to update higher their view on inflation. So they think inflation is going to be stickier and is going to be taking more and more and more hikes to fight it. So let's see how many more hikes we still have in the pipeline. May is consensus now as being maybe the end of the tightening cycle, but we'll see. But even with all of that, they are still expecting inflation to be persistent and growth slowing down. So this is stagflation. We're already starting to see that we're stepping into a stagflationary environment, and stagflation, our definition, is when inflation is too strong that it hurts growth. And if we do have inflation sticky at about 3.54% and growth just crumbling, well, this is stagflation. Thinking that the Fed will cut in H2, given the projections that you see here that are theirs, again, it's not consistent. And if you look now maybe at consumer expectations, which we got this week, we had the consumer confidence survey from the conference board. On the left, this is the expectations component. So they ask many questions. They ask, how are things now, and how do you expect things to be in the future? So on the left, you have the expectations component, which is relatively low right now. And it's lower than the current situation view. So that brings us to the right of this chart. So the blue line on the right is you take the expectations minus the current situation. So the lower this gets, this means that households are thinking that things are going to get worse in the future. And look at how the blue line correlates very strongly with the gray one, which is the yield curve, so 10-year minus 2-year. So both are very useful guides for timing recessions, and now both are sending recessionary signals. So the economy is going to be slowing down. This is by design to fight inflation. It would be premature likely to expect the Fed to cut soon, unless maybe something happens again with banks. They're forced, there's something unexpected that hits the US economy, the global economy. But if you just look at the fundamentals here, it's clearly not the case that the Fed is just about to reverse its stance on monetary policy, even though the economy is slowing down. So what to watch next week? We'll have the employment reports on both sides of the borders, both sides of the border. So always very important data points. We'll have the Bank of Canada Business Outlook Survey, and we'll have the set of PMIs. We'll have the manufacturing PMI in Canada and manufacturing and services in the US. So that wraps it up for the week. ia.ca/economy is your go-to webpage. You'll find everything that you need there. And I'll be back again next week.